Forget the Fed. In 1720, a killer invented modern money. John Law printed fortunes backed by a swamp. It was the ultimate Ponzi scheme approved by the king, and the pattern is happening again.
So let's just start right here. This quote, it's not just a dramatic opening line. It's really the key that unlocks a pattern, a story that repeats itself from the 18th century all the way into your retirement account today. We're going to break down this 300-year-old story not just as a piece of history, but as a blueprint for one of the biggest risks sitting in the market right now in 2026. This isn't just about what happened back then. It's about understanding the mechanics of what's happening now. Our story kicks off with this absolutely wild character, a Scottish gambler, a financial genius, and a convicted killer named John Law, and his masterpiece, the Mississippi Company. And look, this isn't some dusty old history lesson. This is a masterclass in financial mania, in mass delusion, and the incredible danger of putting all your eggs or an entire nation's wealth into one single concentrated bet. It's a pattern of human behavior that, as we're about to see, the financial world never quite seems to learn from. So let's just walk through this because the timeline is just wild. Picture France in 1717. The country is totally, completely broke after years of war and royal excess. In walks John Law with this radical new idea, a central bank that can issue paper money. But here's the twist. It's not backed by gold in a vault. It's backed by the future profits from France's massive, undeveloped land in North America, Louisiana. The government is desperate, so they say yes. By 1719, whispers of gold and silver in Louisiana turn into a full-blown frenzy, and the stock price just explodes, from $500 to an almost unbelievable 18,000 livres. The speed of it all is just staggering. In a couple years, people were selling their houses, their family heirlooms, literally anything they could get their hands on, just to buy a piece of this dream. But then, a few savvy investors started quietly asking for their profits in gold, not more paper. And that whisper became a murmur, then a shout, and pretty soon, it was a full-blown stampede. And of course, the bank couldn't pay. The crash was even faster and more vicious than the rise. And this is the dirty little secret behind the whole thing. The valuable land that was supposed to be flowing with gold and riches, well, it was mostly just undeveloped, mosquito-infested swampland. There was no real economic engine, no real value being created at all. So you might be asking, how did Law pay those incredible returns to his first investors? Simple. He just used the money that was pouring in from all the new investors. Yeah, it was one of history's first and maybe grandest Ponzi schemes, all with the blessing of a government that was just thrilled to watch its national debt disappear into shares of this magic company. So when all the smoke cleared, who was left holding the bag? Well, the French government got exactly what it wanted. It had basically tricked its own citizens into taking on its massive debts. A few insiders who were smart enough to sell at the top made out like bandits. I mean, one guy famously filled a wheelbarrow with gold and just got out of town. But the losers? Well, that was an entire generation of the French middle class. We're talking shopkeepers, doctors, artisans, people who had saved their whole lives and thought they were investing in the future of their country. They were left with nothing but stacks of worthless paper. The damage was so bad it created a deep-seated hatred of stocks and paper money in France that lasted for decades. Okay, so what on earth does this story about a charming con man from the 1700s have to do with you? With your 401k, your retirement plans right here in 2026? Well, it has everything to do with them. Because the fundamental risk, this idea of concentrating all hope and all capital into a very small number of can't-lose assets, it's happening all over again, right now, inside the very investments that are sold to you as being the safest. See, instead of one company promising riches from faraway swamps, today's concentrated bet is on a handful of tech giants that seem completely unstoppable. I want you to think about your portfolio like a house that you're building. You'd want that house to be supported by dozens of strong, sturdy beams, right? You want a solid foundation. But what if you found out your builder had constructed the entire thing? The walls, the roof, the whole shebang, on just 7 massive beams, and everything else was just kind of hanging on. That's what the market looks like today. This really just lays it all out, doesn't it? In 1720, the story was about the infinite, untapped resources of the New World. In 2026, the story is about the infinite, untapped potential of the digital world. AI, cloud computing, global networks. Both are built on these incredibly compelling stories of inevitable success. Both rely on a widespread belief that this time is different. And in both cases, you see a massive concentration of the public's money into a tiny number of assets that feel like they're destined to grow forever. And this chart just puts it in perspective. As of early 2026, the S&P 500 index, the thing that is the foundation of most retirement plans, the very definition of diversification, has over 30% of its total value crammed into just 7 companies. Let that sink in for a second. Out of 500 companies, just 7 of them. That's a tiny 1.4% of the total number of companies make up almost a third of your investment. Just to give you a little context, back in the 90s, that same number was closer to 15%. We have literally doubled down on the concentration, placing a much, much bigger bet on a very small group of winners. Now, it's so tempting to look at the Mississippi bubble and think, well, that was a weird one-off thing from a long, long time ago. But it's not. This pattern of falling in love with a small group of can't-miss stocks, driving their prices into the stratosphere, and then suffering a brutal, years-long hangover, it has happened over and over and over again. It's not a bug in the system, it's a feature of market psychology, driven by greed and the fear of missing out. Let's look at 2 more echoes from history. In the early 70s, Wall Street was obsessed with the Nifty 50. These were the blue-chip, solid companies like Polaroid, Kodak, and Xerox, the tech darlings of their day. The thinking was you could buy them at any price because their growth was guaranteed. Then a recession hit, and Polaroid dropped 91%. Some of these safest stocks took a quarter of a century just to get back to where they started. Or fast forward to Japan in 1989. The story was that Japan was going to take over the world economy. The Nikkei index was the biggest on the planet. If you invested at the peak, you lost 75% of your money and had to wait 37 years just to break even. The point is this: a story of inevitable dominance mixed with insane prices is a historical recipe for financial disaster. So, if this pattern is so obvious throughout history, why are so many of us walking right back into the same trap? Well, the answer is that the modern financial system has become incredibly good at hiding this risk. It uses comforting language and automatic, invisible systems that push us in this exact direction, whether we realize it or not. This is the great myth we're all sold from day one. We hear the word diversification and we picture our money spread out nice and evenly, like butter on toast, thin, safe, across hundreds of different companies. It's a really powerful and comforting idea. It suggests there's safety in numbers. But is that what's really happening? And here's the reality. This cuts right through all that marketing jargon to the cold, hard math. In 2026, when just 1.4% of the companies in your diversified fund are responsible for 30% of your outcome, you're not diversified. You are, whether you know it or not, making a huge, concentrated bet that those 7 companies will continue to outperform everything else forever. They've just called it diversification. It's a neat linguistic trick. And this right here, this is the hidden engine that drives the whole illusion. It's called market cap weighting. It sounds complex, but the idea is actually dangerously simple. All it means is that as a stock's price goes up, the index fund is automatically forced to buy more of it to keep its percentages right. So all the new money coming into the fund, your money, my money, everyone's money, automatically flows to the stocks that are already the biggest and the most expensive. You are, by design, buying high. And this creates a powerful feedback loop. Rising prices lead to more automatic buying, which leads to even higher prices, which creates more and more concentration. This is such a critical mindset shift. We've all been trained to be passive passengers, just buy and hold the index and trust the system. But we have to remember the financial industry makes its money from fees on your assets, whether your account is going up or down. Their main incentive is just to keep you in the system quiet and passive. But you are not just a passenger on this ride. It is your future, your money on the line. And realizing that is the first step in going from being a passive product to an active manager of your own financial life. Okay, so we've laid out the problem, we've looked at the history, we've uncovered the hidden mechanisms. That's the hard part. But the good news is you are not helpless here. You can absolutely take control. So let's switch gears and talk about the solution. This is an actionable 5-step playbook to help you build a stronger, more resilient portfolio that's ready for more than just one possible future. So, these are the 5 pillars of a more proactive strategy. The whole idea is to shift from being passive to being engaged, from just hoping for the best to actually preparing for a bunch of different outcomes. And we can start with something you can do tonight in about 5 minutes. Step 1, check your actual exposure. Just log into your retirement account, pull up your S&P 500 fund, and look at its top 10 holdings. Add up those percentages. Just see the concentration for yourself. Knowing is half the battle. Now let's jump to step 3, because this is such a powerful tool for taking emotion out of your investing. Valuation tripwires. They're just preset rules you make for yourself when you're calm, cool, and collected to protect you from your future panicked self.
For example, you could decide that if any single stock ever grows to be more than, say, 8% of your total portfolio, you automatically sell a little bit. Or if the market as a whole gets super expensive, like if its PE ratio goes above 30, you automatically move 10% of your stocks into safer things like bonds. This isn't about perfectly timing the market. It's about enforcing discipline and methodically reducing risk when that risk is getting obviously high.
So what might a truly diversified portfolio look like? Now, this is just an example, it's not specific advice, but it shows the philosophy. Notice we still have US stocks for growth, but maybe in an equal weight fund where every company gets the same slice of the pie. We have international stocks because, hey, other parts of the world might not be as pricey. We've got real assets like real estate or commodities to hedge against inflation. We have bonds to act as a shock absorber when stocks fall. And critically, we have cash. Cash isn't just sitting there doing nothing. It's your opportunity fund. It's dry powder, ready to deploy when other assets go on sale. Every piece has a job to do. You know, beyond all the tactics and the percentages, the single most important change is really psychological. It's about fundamentally changing how you see your role as an investor. It's about moving away from that passive, hope-based approach and adopting a more engaged, active one. This metaphor just perfectly sums it up. For decades, we've been taught to treat our portfolio like a little houseplant. You know, you just put it on the windowsill, add a little money every month, and hope for permanent sunshine. But that approach is so fragile. It works great until it doesn't. A gardener, on the other hand, is engaged. They know seasons change, they pull weeds, they prune back the things that have grown too big and risky, they rotate their crops. A gardener doesn't just hope for good weather. A gardener actively manages the garden so that it can survive any weather. And this is the ultimate payoff. When the next market storm comes, and trust me, it will come, the person with the houseplant feels like a victim. They're shocked, they're powerless, and they panic sell at the absolute worst possible moment, locking in huge losses. But the gardener isn't happy about the storm, but they're not surprised. They've prepared for it. Their portfolio was built for this. They can hold on through the tough times and maybe even use that cash they set aside to buy more when everyone else is terrified. That is the profound difference between destroying your wealth and actually building it through market cycles. So I'll just leave you with that one question. Take an honest look at your investments, at your strategy. Have you just put a single plant on the windowsill and are hoping for nothing but sun? Or are you actively tending a resilient garden, one that's prepared for all seasons? The choice you make is going to determine not just your financial outcome, but your peace of mind when the weather inevitably changes.